I would like to call Ms. Ranjani Sivaraman. She is the Deputy General Manager of Indirect Tax in Chettinad Group of Companies. Can I have you on stage, ma'am, please? A big round of applause for her. She is going to present a presentation and explain you the interplay between the income tax and GST laws.
Hi, good afternoon, everybody. I know we've all had a very heavy lunch, and we are also looking forward for the tea. So I'll try to make it as short as possible. First, thank you for inviting me here, and it's truly been an honor to be here. And I would like to applaud you for taking efforts to organize a specific session on taxation for one whole day. Taxation has always been considered a part and parcel of the business. To see such a stage being presented for taxation, it really gives me glad and happiness. Yes, so all speakers before me have emphasized enough and more about the compliances which is required from a direct and indirect tax perspective. Mr. Vasudevan, speaker before me, spoke about how to simplify compliance. Here I am telling you that the law itself is complex, so simplification might not be possible. We are also going to be talking about the interplay of GST and indirect taxes. That's been the topic which I've taken. Integration of compliance to the law as much as it is required. All our disclosures which we do in the GST and income tax matters a lot. I am here to talk about what the GST authorities are doing, how GST authorities are looking at the data which is being presented for the purpose of income tax, and what are the kind of questions or what are the kind of positions we should be taking, keeping in mind both income tax and indirect tax. So as early as 2015, there was an MOU which was signed by the CBDT and CBEC, Central Board of Excise and Customs, for sharing of data. Now, in my view, it was not very successful for two reasons. The indirect tax laws then had a VAT component. So VAT laws were also available at that point in time. VAT was a state subject, excise and service tax and customs a central subject. We all know how the data is being shared from the center and the state. We also know at that point in time the data was not digitally digitized, or it was not available in the form in which it is available right now. In 2017, with much fanfare, GST was introduced. And the emphasis has been enough and more laid from today's sessions that artificial intelligence is the way to go. So all data is available digitally across the spectras. And income tax has revamped their portal to quite an extent that all information available in income tax is available in GST, available in GST is available in income tax as well. In this background, in July 2020, a fresh MOU was signed between CBDT and CBIC now, Central Board of Indirect Tax and Customs, for sharing of data. After this, amendments were also made to GST laws, and we have our annual information report, we have our tax audit reports, and every other piece of compliance where we are providing all the information. Now, like I said, so this is the MOU snapshot which I thought I will present. Like I said, I'm going to be focusing mainly on the laws and how the laws are getting difficult, though the compliance might be getting easier. Let us not forget Article 265 of the Indian Constitution, which says, no tax shall be levied or collected except by the authority of law. So this is the foundation or the basis on which both the income tax and the indirect tax operate. Unless it is an income for the purpose of income tax or a consideration for a supply for the purposes of GST, whatever sharing of information happens, whatever sharing of data happens between these two people, tax can neither be levied nor can be collected. Now, is it that in every transaction, whatever constitutes income will constitute consideration for a supply? Or is it that every consideration for a supply will constitute income under income tax? That's been our general understanding, but no. There are situations where transaction will attract the income tax, but will not attract GST. And there are situations which I'll be explaining which will attract GST, but not the income tax provisions. I have listed down quite a bit of scenarios, but let me handle only one or two. So let us talk about sale of non-agricultural land, or let's say sale of shares, for example. Now this, by virtue of the sale, I will be having some income which is coming into me. Clearly, capital gains tax will be applicable, capital gains long-term or short-term will be applicable on these transactions. But there is something called as a Schedule 3 for the purposes of GST, which says these kind of transactions are neither supply of goods nor supply of services. So on one hand, the income arising out of this will be attracting income tax, but the same will not be subject to GST. So there is a mismatch between these two data. So I will have to be very clear why it is taxable under income tax, why not under GST. Similarly, a high sea sale transaction. Now high sea sale, everyone is aware, I'll be importing the goods. Before the goods cross the customs frontier, I'll be selling the goods to someone else by passing the title. Now once that title is passed, that company will be importing the goods physically. This high sea sale transaction is also a Schedule 3 transaction, which means it is neither supply of goods nor supply of services. Income from this is definitely subject to income tax. Similarly, any amount received as a compensation. Now compensation, there's so much to discuss about this in detail independently, but in a nutshell, GST is not leviable on any amount which is received in the form of a damage or a penalty. There's no such distinction for the purpose of income tax, and income tax is levied on this. There are so many other scenarios where it will attract income tax, it will not attract GST. Going to a vice versa situation, there are transactions which attract GST that does not attract income tax. Like Mr. Vasudevan was mentioning, stock transfer is a classic example. Now GST is a very state-specific subject in the sense, wherever if I'm locationally placed across states, I will have to take separate registrations. So when I'm stock transferring from, let's say, from Tamil Nadu to Karnataka, then I will have to be levying tax on this because of a specific provision in GST. Now income tax doesn't recognize this concept. There is no concept of business by self. There is no concept of income from oneself under the income tax. So this particular transaction, even though will attract GST, will not attract the income tax provisions. Similarly, let's say there is an income which I have billed, but it is not recognized. Well, now when can this scenario arise? Let's say I'm running an education institution. My academic year is from July to June. I am collecting the academic fees for the year. Definitely for 1 year, I'm collecting it beforehand. So I've collected all the income, all the fees in the month of June itself. But for the purposes of income tax, I'll be recognizing income only for the period of 9 months. I will not be recognizing income for 12 months. As against in GST, I will have to declare the total sum as the turnover for that particular year. So there again, there is a distinction between how this particular income is recorded for the purposes of GST vis-a-vis the income tax. Let's take a scenario of sale consideration versus profit and loss on sale of assets. Now, all of us are aware, in case there is sale of any asset, the only thing which gets recorded for the purpose of income tax is whether there is a profit or a loss. If there is a profit, treatment is meted out by paying tax. If there is a loss, that's getting adjusted. Now, this is not the scenario in GST. In GST, we will have to pay the tax on the sale consideration as against the profit, which is only getting taxed in income tax. So this is also a reason why there might be differences between income tax and GST. Now, these are the various examples where the dichotomy can arise, and therefore it becomes necessary for us to have a proper compliance. We have to record all these transactions properly, and we'll have to do a reconciliation between the income tax disclosures and the GST disclosures. Now, you're saying there is one more scenario where yes, subsidy, yes, I agree. Now, subsidy has its own dimensions of whether it is a subsidy under GST, but yes, I agree. Now, these are the scenarios of differences. What I am trying to do in the next slide is talk about how there have been certain legal developments in GST which has impacted income tax, or what are the changes that has happened in GST which might have some impact under income tax as well. The first is the issue of secondment. Now, we are aware what a secondment is. So, in brief, a secondment is where I have a foreign employer, a foreign person coming to India, attaching themselves as a part of an employee in the Indian roles, simultaneously being present in the overseas group company roles as well. Even though for the period they are working in India, they will be getting paid only by the Indian entity. For the purposes of social security, they will be continuing in the foreign payroll, foreign entities payments as well. Now, there has been a decision of the Supreme Court in March 22, which said this kind of an arrangement where the foreign person, secondee, is going to be coming to India and he is calling himself an employee, is not an employer-employee relationship between the Indian company and that person. It is a scenario where the overseas group company is providing services to the Indian company, and please do not call this transaction an employer-employee transaction. This is what the Supreme Court has said. Now, before the Supreme Court decisions, income tax and GST were running parallelly together. Income tax and service tax, I should say, were running parallelly together in their thought process. And they said, okay, fine, as long as you're paying PF, as long as you're deducting tax appropriately under the income tax, this person will qualify as an employee for the purposes of service tax as well. Therefore, there is no service which is rendered by the foreign company to the Indian counterpart. This Supreme Court decision has unsettled all that position. GST spate of notices, all of us know. This has also been a point of issuance of notice for the purpose of GST. What is happening in income tax? I understand that various cases are pending in high courts right now, where the department is heavily relying on this case law to say that there is a service which is being provided by the overseas group entity to India. What that service constitutes, the payment constitutes a fees for technical services. Appropriate TDS has not been deducted under the income tax provisions. Therefore, demand is payable by them. That is what is happening in the income tax front as well. The decision which I talked about is a service tax decision having an impact on the income tax provisions as well. Next is the CSR expense. The arrow eppadi click pannu? So, all of us are aware about the CSR expenditure which every company having a particular turnover or having a particular net profit scenario has to incur. It is 2% of their average net profits which they will have to incur on a year-on-year basis. Now, that is coming from section 135 of the Companies Act. There was always a dispute on whether this is, since it's mandated by law, whether this amount can be claimed as an expenditure under income tax or not. And now you had the amendment in 2015 which said, sorry, this cannot be treated as an expenditure, so you cannot claim any deduction. Again, there is a provision under the Income Tax Act which said you cannot claim any deduction. The expenditure was being incurred. Tax on the expenditure was also being paid. SSEs were taking credit of the tax which was being paid. The issue in service tax or the GST arose on whether this credit which was being taken is a valid credit or not. Here, there were certain decisions by the Mumbai tribunal which said credit is rightly availed. There were decisions of the Delhi tribunal which said, no, these credits cannot be taken. What has happened, because of this confusion, an amendment was proposed in the GST law. That amendment provided, there was an, there's section 17.5 which restricts credits, and the CSR expense was also intended to be brought into this ambit, and it is being effective from October 23. Now, I just want you to read this provision, especially the highlighted portion. 17.5, which talks about restriction of credits, say goods or service or both received by a taxable person which are used or intended to be used for activities relating to his obligation under the CSR referred in section 135 of the Companies Act. Wherever I am incurring an expense relating to my obligation under 135, then the credit on the CSR expense is restricted. Now I am going to 135. 135 said, I have to spend at least 2% of my average net profits for my CSR compliance. There was a proviso which was inserted, I think around 2020 or something, which said any amount which is spent in excess of the requirement provided under this subsection. So they made 2% mandatory. It was not at least 2%. I think it became at most 2% because of the proviso. So any amount which is being incurred up to 2% as per 17.5 is restricted clearly. What is going to happen to the amount which I am spending more than that? Let us say I am spending 5%. Can I still take credit for the 3%? Remains a question. Now, if I take a credit, will that be still restricted under 17.5? Because I am allowed to adjust that extra 3% for my subsequent CSR requirements. Can I reduce that credit which I have taken and use that balance amount for adjustments? All these are questions which remain to be answered. Tax is definitely not easy and simplified. I doubt compliance will still be simplified. On the back. Next is the issue of corporate guarantee. Corporate guarantee again is a very usual transaction in any company having to take loans from the banks. There is an entity which promises to give a guarantee to the bank if a loan is being availed by a subsidiary. Let's call it parent and a subsidiary relationship. The parent company will give guarantee to the bank saying that the subsidiary company will repay the loan. Otherwise, I am the defaulter and you can collect it from me. This is the concept of a corporate guarantee. Being a parent and a subsidiary, it is understood that this transaction is a shareholder transaction. Now, there has always been disputes under income tax as well as under the indirect taxes on whether there is any service which is being provided by the parent company and to the Indian company, and therefore whether any tax is payable at all for the purposes of GST, or whether any adjustments have to be made on this account for the purposes of income tax. Now, under GST, there has been an amendment which says that corporate guarantee is a service. You have to assume 1% of the guarantee value or the actual consideration as the value on which you have to pay tax. Now, actual consideration there might not be any, or if there is some, it's good, but 1% of the value is what we are talking about. Under income tax, as far as I have seen, the deduction permissibility has only been 5.5% to 0.8%. It has never been more than that. For the purposes of GST, I am saying 1% of the value. For the purpose of income tax, I do not know. Whether it's 0.8% or will they allow this 1% which I am paying, we'll have to wait and watch. Import valuations, again, we had an interesting session on the cross-border taxation in the morning, and there were so many issues which were brought in then. Import valuations and PE versus non-resident taxable person is something which is a part of that. In a very two-liner, import valuation is where I'm importing the goods. I'm adopting a value for the purposes of customs. Customs give me certain additions which has to be made mandatorily. I make those additions, pay customs duty. I'm talking about imports from related parties. When there's an import from related party, obviously the transfer pricing provision kicks in, and the transfer pricing provisions are diametrically opposite, if I can say, to the customs valuation. In customs valuation, the purpose is to tax a larger sum. In transfer pricing adjustments, it is to reduce the payable, reduce the expense, so-called expense. How am I going to be matching these two? This is something which, if we are having an import transaction from related party, we'll all have to seriously look into to equalize the treatment between the two. In fact, there have been so many cases where, based on TP reports, customs authorities have come back to say that this is not okay. You will have to pay addition, or you will have to pay me the extra along with interest and penalty. The last is PE versus non-resident taxable person. Now, there is a concept of non-resident taxable person which has been introduced predominantly in GST. Non-resident taxable person is any person who does not have a place in India, but who is undertaking certain transactions occasionally in India. Yes. So, a non-resident taxable person means any person who occasionally undertakes transactions involving supply of goods or service or both, whether as a principal or agent or in any other capacity, but who has no fixed place of business or residence in India. We have the concept of PE, different kinds of PE which is there under the DTAAs under income tax. Let us take a scenario of an international player who is coming to India, IPLs, T20s, all of us are big fans of that, so I'm taking that example. He is coming to India, he is spending predominant time here. Let's assume that a service P gets created. He also pays income tax. He fails to register himself as a non-resident taxable person. He is not aware about the GST provisions. He does not know, no one has advised him. What is going to happen? Merely because he is declaring in his income tax that because of a service P existence, I'm going to be paying tax in India, can GST not be paid? Or the GST authorities find it very easy to pick it up from that data to say that GST has to be paid on this transaction. Sir, back page now. Now, these are the franchisee will also be located outside India, but as a non-resident taxable person, if you are supplying something here, he is liable to pay tax in India. And import of service, even assuming an RCM is applicable, he is not the person who is liable. So the department will come back again to say, you claim a refund, but he will have to be paying tax. Now, these are the legal issues which we talked about. I'm going to be talking about the disclosure-based issues, and that's where all our compliance and the AI tools come into help a big time. Now, this is one of the notices which I had received recently for one of my registrations. I had received 18 points of information to be submitted. First 8 relates to income tax and financials. Balance is all my 2A, 3B reconciliation or the data which is readily available in any AI tool. Now, this is the kind of information I am asked from an income tax or a financials perspective. Broadly, 1, 2, and 3 is fine because we submitted at the time of filing GST 9C anyways. Now, point number 4, they're talking about statement of depreciation claimed under income tax. How is it relevant for the purpose of GST? Under GST, I will not be eligible to take credit on my plant and machinery if I'm claiming a depreciation under income tax. So this particular information which I'm giving is more than enough for the GST authorities to check whether I've claimed any credits and whether those credits are correct or not. This will also help in understanding whether the expense has been capitalized. So as long as the expense is capitalized, I can't take credit. So this particular information, this point number 4 alone, is sufficient to create a huge demand right now. Next, we are going to annual tax statement, that is Form 26AS. More specifically, after the amendments and after the MOUs, it's become very stringent. I've just taken one portion, the first portion of Form 26AS. I'm not even going beyond that. We are talking about the tedious disclosures in Form 26AS. I've tried to compare where all it might have a GST implication. The first section under income tax is 194A, tedious on interest. How can this be relevant? Interest income is anyways exempt under GST, so there cannot be any relevance of this. No. When I'm claiming something to be an interest income and claiming it as an exemption, it is my responsibility to prove that it is actually an interest income. So through this disclosure in Form 26AS, I will be able to substantiate I had deposited so much money in these banks. These banks have deducted so much TDS. I will have to arrive at the value and then prove that this is the actual value of interest income for me, which is not leviable to GST. Now the second one, 194J, TDS on fee for professional or technical services. Where can this be relevant? This can be relevant in any scenario relating to a director remuneration. Director remuneration, very big issue under GST, whether it is taxable or not. Somewhere GST authorities have agreed to go hand in hand with the income tax authorities to say as long as he's an employee, no problem, you don't need to pay tax. This, if I'm going to deduct, it does not mean he's an employee. It means that I'm paying something more to him despite him being an employee if he is one. So if I'm paying this, I will have to ensure that appropriate GST is also being paid on this amount. Next is the 194I, TDS on rent of land, building, furniture, fittings, etc. This will help them to analyze whether appropriate tax under GST for renting of commercial space has been paid or not. Similarly, the next provision 194IB, if this gets attracted, wherever there is a, now under GST, if there is a renting of immovable property for residential purposes to a registered person, then tax is payable on that transaction. If I'm going to be providing this information to him, the first question he's going to ask me is, whom have you provided it to? Whether you have provided it to a person who is registered. If I'm going to say yes, then his next question is, have you paid tax on this or not? This is not some information which he is digging deep at all. This is an information which he is taking from Form 26AS, which is readily available. The next is section 195 TDS, which is TDS on other sums. Wherever I am making foreign remittances, It is my job to ensure that if a tax is payable on that, I am paying tax on that. So just on the tedious disclosures portion, it is very, very clear that I will have to be doing my reconciliations, number one, before finalizing my 99C, or at least at the time of providing the information to the audit authorities. Tax audit report, I have specifically and consciously not captured 44, serial number 44. That requires a separate discussion and definitely is not, this time is not enough. Now tax audit reports, I have taken some very, very small issues which can be picked up from here. Let's go to 10B. It says list of books of accounts maintained and the address at which the books of accounts are kept. Now, if I am providing this information, I will have to necessarily cross-check in my GST returns whether all places of business have been registered under GST or not. If I am saying there are 10 places of businesses here, there cannot be 2 places of business in my GST returns. They will have to match. There is no way that it doesn't match. Unless you are going to say that there is no supply from that particular place or a place where the books are kept. Escalation claims, whether the tax has been, for an escalation claim, we generally raise a debit note. With debit note, we have to pay interest as well. So whether tax along with interest has been paid. So I think so many other information from the tax audit report, apart from serial number 44, is also relevant. We have the GST assessments and the income tax assessments. Whatever position we are adopting here, let's say I am paying tax during GST assessment, I will have to ensure I am eligible to claim it as an expenditure. Now, whether it is a penal nature, whether it is not a penal nature, that's something which we will have to decide at that point in time, depending on the kind of notice. If it's a Section 73 notice, we can still argue it's not penal. Section 74 notice, I have my own doubts on whether it's arguable or not. Similarly, income tax assessments, where if an expense is disallowed as a business expense, whether I have ended up claiming credit, should I reverse the GST credits, or where there has been any search, where I have disclosed any particular income there as from the sale or from a service, whether I end up paying appropriate GST, because there's no concept of revision of returns in GST. So I will have to pay tax separately on this. Now, there is so much of an interplay. Therefore, with this food for thought, I would like to thank you all for being such a wonderful audience.
Thank you so much, Ms. Ranjani, for giving such an insightful session. I would like to call Ms. Hemlata Saptashi, the Head Enterprise Sale from Eris GST, to felicitate Ms. Ranjani Sivaraman for the DGM of Indirect Tax from Chettinad Group of Companies for her presentation and hard work. Please. Can we have a round of applause? Thank you, ladies.